After a blasting from the Senate, the former leaders of several U.S. banks that collapsed in March were back on Capitol Hill for a second day of questions over their role, this time from the House of Representatives. Former Silicon Valley Bank chief executive Gregory Becker and his peers are under fire for their management failures. But Becker has been singled out in particular for the tens of millions of dollars he earned and increased by selling his shares just before SVB collapsed in one of the biggest runs on deposits in history.
Do you think that the bonuses received, Mr. Becker, Chief Executive Officer, should be returned?
Congressman,
that would be a yes or no. The
expect to
chair is ready to
with
sound the hammer.
Congressman, I will cooperate with the process that I know will be.
Well, we're going to have some clawback legislation for you to cooperate with.
Becker was joined by the former chairman of Signature Bank and, for the first time for these hearings, the former chief executive of First Republic, the last of 4 regional lenders to fail.
Instead of dealing with temporary decreased earnings due to interest rate pressures, First Republic was contaminated overnight by the contagion that spread from the unprecedented failures of those banks.
Like Silicon Valley, First Republic racked up huge losses on investments whose value dropped as the Federal Reserve began raising its benchmark interest rate to counter rampant inflation. Those losses became a liquidity crisis when panicked customers who'd made deposits far beyond the $250,000 federally insured limit rushed to withdraw tens of billions of dollars in just hours. Risk management failures aside, the banks were also victims of an unprecedented type of bank run. Most of these banks insist they were well capitalized and could have ridden out the storm, and yet regulators who seized them clearly disagreed. But it's also clear that these banks were no match for the era of social media, which accelerated the panic and contributed to depositors pulling out their money so quickly. And yet regulators have admitted they've yet to devise a coherent strategy for how social media influences banking. Experts say bank supervision now needs to move from a mostly backward-looking exercise to real-time monitoring when banks start to pose a risk. Owen Fairclough, CGTN, Washington.